Welcome viewers, you're watching the Mortgage Buster Show and we're all about helping you pay down your mortgage in record time, right down to nothing, so that you can go to your bank and say, Mr. Bank Manager or Miss Bank Manager, can you please give me the title to my property, because that now is mine and I would like it in my safekeeping, thank you very much. My name's Greg.
I'm Adrian.
And we bring all the professionals on to show you how to do everything with regards to making sure that your mortgage is paid down as quickly as possible. We're also helping people build up their wealth base so that they can live a comfortable, very comfortable life in retirement. We're making sure people have all their insurances covered, their superannuations in place, all the rest of it. Now, let me ask you a question. Have you had your thumbprint report done? Because that's what we offer on this show, is a free thumbprint report.
That's right.
And what's good about that is one of us from the show will come and see you. We'll sit down and talk to you, talk about your needs, goals, all that sort of stuff. We'll create a report around all that, put all your numbers into the one place, and it will give you options in terms of a plan, a program, a goal to aim for in terms of getting that mortgage paid right down as quickly as possible, and retirement. We've got Stuart back with us again. Last week we talked about insurances. Stuart McGilvray from Phalanx Financial Services is going to be talking to us about superannuation.
Yeah,
welcome back.
Not a problem, guys. Happy to be back. So
We had a great response to last week's show.
yeah, no, it was really good, and I felt that was the sort of thing we needed to get out there, because insurance is something that people did need to review, and by the same token, super is another thing. I think.
Yeah, absolutely.
Well, both of them are taboo. Nobody wants to know anything
No,
about them.
yeah, I know.
I mean, they're not the sort of topics, I suppose, that.
Bring any
Yeah,
enjoyment.
yeah, really.
We did talk about procrastination last week, and you know what? It's the sort of thing that you do want to procrastinate on.
It is. I know. A lot of people, if they're
time.
they're doing their everything, or their 9 to 5 every day, and then their weekends with family, the last thing they want to do is worry about this sort of stuff.
Yeah,
And,
exactly. But you know what? Once it's done,
Yep.
you can sleep well at night.
Well,
You
someone
can
will
just-
thank you.
Yeah,
Yeah, well, that's
absolutely. Yeah. All right. So the other half of you concentrates and works around the whole notion of superannuation.
Yeah, absolutely. So, by the same token as what we were talking about last week, I think with super, there's no harm in actually reviewing how your setup is at the moment. Quite often people, if you've worked in 10 to 15 jobs over the years, for example, there's every chance you've got 10 to 15 super funds out there that you don't even realise. And what happens with this money is it continues to pay fees, whether it's admin fees, you might have insurances in there that you're not even aware of.
It's not being contributed to anymore, but
Not
it's
being
been
contributed, but
eroded
it's
away.
actually eroded away.
Yeah,
So, I mean, for starters, very simply, you can save yourself some money by not having 15 funds. You can
Yeah.
actually have one fund set up, which is the most appropriate for you, with one set of fees, and for the most part, most people are better off just by doing that straight off the bat. So,
Look, I can confirm that they're out there. You know, as I said last week, we do see a lot of people on a daily basis.
They've forgotten.
And people, we talk about superannuation, we might, ask them, what sort of super do you have?
Yep.
And they'll say, we've got 3 or 4, but we don't know where they are, and we've got to get them all together one day. They've got the idea that they'll do it, but they never get around to doing
yeah.
it.
So
But
that's
they're out there.
Yeah, that's the procrastination again, unfortunately.
Of course.
But yeah, it is very easy to do. It's not something that takes weeks or months. It's very simple. What happens is you'll either have the funds themselves just need to be contacted and let them know what your new super fund that you're going to use is, and they can send the money over. Or alternatively, it might have even been swept over to the ATO by now if it's been a really long-standing thing. And
How long is there a time?
it depends on the fund, I think. So you can find it varies from fund to fund, but
Are we
you can
talking
run
10 years, 5 years?
I'd work on the basis if it's been longer than 5 years of basically being inactive. Chances are it's probably with the ATO by now.
And what does the ATO do with it?
Well, it just sits there. It sits there until someone
it's claimed.
knocks on the door and asks
But it's
for
funny,
it.
I got a
and,
check for $11 for one super.
Yeah.
They're from the ATO.
Yeah.
Yeah, it was $11 something.
Gee.
But the erosion
From
can
something that
happen.
was-
No, but it was
Yeah.
originally 11,000.
Yeah, 11 minutes, sorry.
Yeah. I mean, the erosion happens quite quickly, especially if you've got your admin fees. But if you've got insurances that you don't really need because you've got other ones elsewhere, before long, if you've got a number of different insurances all being paid from different funds, it can erode quite quickly. So it's the sort of thing, the quicker you sort of start taking
Act
some
on
action with it, yeah.
Yeah.
So why would they have
So-
sent that one back if...
Yeah, so it can
How
happen.
does that work?
Yeah, so the way it tends to happen is you've got different funds out there that, for whatever, you might have changed address and they can't get in touch with you anymore. They might have just lost your details for whatever reason. There's a range of different reasons it happens. There's actually an easy way to do it these days, which is a super search, and you can actually run a check for missed or lost super that you've got out there and start doing something about it. So
It's actually called Super Search.
super search, yeah.
Search, yeah.
So you do this for people?
Yeah, of course. So that, a big part of what we would do is actually review their situation, what their goals are, what they're trying to achieve, and figure out the best structure for their super. So there's different options out there in terms of super. There's not just one fund. There's different options for different people depending on what they want to do. Once we establish that, then we can start taking some action about, now that we know what we're supposed to be using, let's actually roll everything into that fund if that makes sense and go from there. So,
Do you also help clients with self-managed super funds?
yeah, absolutely. So self-managed super has been one of the most popular options in recent years. It gives someone complete flexibility and control about their retirement savings. And after the GFC, we had a lot of people that were very, what's a nice way of putting it? They weren't really all that happy with the pie chart that's invested in a range of different things.
Yeah,
and they
right,
wanted some more clarity about where their retirement savings were invested. So if a self-managed super fund's the sort of thing that you're looking into, yeah, definitely review it with professionals, because it's the sort of thing that you want to do. And
Well, absolutely. Now especially that you can buy property through
that's it.
leveraging in super. Yeah.
So the property thing, not only can you buy property, but you can actually borrow to buy property too.
Yeah, it's amazing.
So that's been about since 2007, and it unlocks even more opportunities for people that are interested in doing that. So
Yeah,
Is it also
yeah.
good to put your insurances through Super, because you're not going to suffer as much?
yeah, well, certainly for
For the-
people that are really concerned about their cash flow, if they've got the option between paying for it through super or personally, inevitably you'll find most people are happier to pay it through super. So, and with life and TPD cover, you can actually claim a tax deduction for it, which you can't claim if you hold it personally. So,
Oh, wow.
yeah.
Yes, of course. You did mention that last week. I
Yeah.
think. Okay, so do you help people in terms of, should they be making, they've got a bit of extra cash, should they be making extra payments into super, or should they be putting it into their kids' education fund or some sort of investment, all that sort of thing?
Yeah. So there are different types of contributions you can make and strategies that you can come up with to save people on tax. I think we all like to save money on tax if we
Absolutely.
can. And the different contributions and different things out there are all dependent on the family circumstances and what that person's wage is and all that sort of thing. But there are particular things like co-contribution, for example, where you're able to add to your super, and the incentive is you'll actually get an amount from the government as well.
The government. Sure.
There's
Just sorry to do this, Stuart, but
No.
we've got to go to a break.
No,
but we'll
absolutely.
pick it up after the break.
fantastic.
yeah?
Thanks.
You're watching the Mortgage Busters. Don't go away. We'll be back straight after this break. Welcome back. You're watching the Mortgage Busters show, and we are with Stuart McGilvray from Phalanx Financial Services.
Thanks,
Stuart,
guys.
now hang on. Did I hear right? You said something about co-contributions and the government
Actually giving money
giving
away.
money. Yeah, giving money
I
away.
thought that
So
didn't exist
yeah,
anymore.
so there's a lot of different. My opinion on it is that the government wants to make superannuation attractive. So as much as there might be all the doom and gloom about what your investments are doing, or if you've had bad experiences with the GFC and that sort of thing, I think what you'll find is that the government wants to keep it attractive, because the last thing they're going to want to do is pay Centrelink pensions to everyone that hasn't worried about it in the
course.
future. So
Simple question.
Yep.
Do most people have enough superannuation?
not even close.
Yeah, it's
So-
not. It's not, is it? Yeah.
No.
Not even
Nowhere
close.
near,
No.
not even close. There you
No.
go.
So that's why we're working towards 9.5% now is the mandatory SGC amount that has to go in from employers. So
the
that'll
SGC is the super guarantee.
contribution.
Contribution,
Yeah. So
yeah.
so that has to go in. So if you're on $70,000 a year, 9.5% of that will be added to that to go into your superannuation. It's set
But
to
if,
actually.
if you're 53 and you've got $80,000 worth of super, which is very, very common scenario,
Yeah,
even if
not a-
you're
not s-
contributing 20%, is
Yeah.
going to really make that much difference.
Yeah, so there are strategies that you can come up with. Getting to that age, certainly you're wanting to bolster your retirement by that time.
This is why you're on the show.
yeah,
Because
so-
lots of people that watch the show are in this situation.
Yeah, so there are things you can do, like salary sacrificing. So foregoing some of your income now, getting paid a lower amount from your employer because they direct more towards your superannuation. And then from 55 onwards, transition to retirement, where you can actually improve the tax advantages. Everyone's a little bit different with how much they'll be able to save or make from doing that. But yeah, from 55 onwards, it's something you should really be considering. So yeah, there's plenty of things out there to actually help in terms of bolstering your retirement, and putting yourself just in a better position because you're going to have more money when it gets to the day you decide to call it a day and hang up the boots. So there's no time to
Hang up the boots.
Yeah.
I had a client, it wasn't only a few weeks ago, and he said to me, because there's no chance he was going to have enough super no matter what he did, right? And he said, but that's okay, I'm not worried. I'm actually lucky because every male in his family has died before the age of 70, so he's all right. He's covered.
So he doesn't need to plan for anything.
Well, that's the truth. I'm not joking. That's what he said, but
Yeah,
he was joking.
Bit flippant about it, yeah.
Yeah. Because what else can you do but be flippant? Because people feel as though they don't have much control over it. But with your advice and your guidance, you can help people to get to where they want to go.
So there's no age that's too early to start. It's the sort of thing. I mean, most 20 to 30-year-olds probably just don't care about it at all. It's very much all about sort of today and not worried about sort of 20 to 30 years from now. But there is no particular age where you should start looking at it. I think the sooner the better. And even if it's something as simple as the fund you're in, the fees are just atrocious compared to other options out there. That can be the difference in tens of thousands of dollars if you kind of compound it over 30 years. So
what about the opposite? It's never too late either, is it?
Never too late, because
Really?
I think, no, it's not, because there's always things you could be doing to actually structure yourself differently or change the way you're doing things, no matter where you are in terms of age and that sort of thing. And having a plan's a good start. So without a plan, you're almost setting yourself up to fail, and making sure you've actually gone through the process and reviewed where you are and where you want to get to is the first step. So,
what's the problem that you see that most people have? Is it just not having enough?
Yeah, not having enough, not realising they could be adding to it or realising the benefits of adding to it. The multiple super funds is a good one because you've got people coughing up fees that they don't necessarily need to be coughing up.
Of course.
Too much in there, too much in the way of like admin fees and things across the board in terms of all those different funds. Then too much in the way of fees in the fund they're in. So they might have a fund and they've had it set up by someone 10 years ago and just assume that they've done the right thing by them. But like anything, you need to review it and make sure it is doing what it was supposed to do. And things change, like anything. It's there's no harm in reviewing it. And
no, not at all.
Yeah.
Not at all. So when you go to see a client, if someone wants to, take you on as an advisor or whatever, what's your process? What happens? You'll go and visit someone in their home?
Yeah, absolutely. So,
which is very convenient.
Yeah, so I work outside your typical 9 to 5. I'll quite often see people in their homes just because the way the world's going these days, people just don't have time. So at their home, at their workplace, or at the office, it's completely up to them, and I'll work around people's schedules. And that I've found to be quite an attractive option for people. I actually probably spend more time at people's homes than I do seeing them at the office just because it's more convenient for them. And like I said earlier, it's the sort of thing that most people don't get the time for. So if I can make it at a time that suits them, then that tends to work best. But
well, you can't ask for more than that.
No. But
Stuart, it's been absolutely fantastic having you on the show today and last week as well. Two very important topics, insurances and superannuation. Are you covered insurance-wise? Do you have enough superannuation? Jump on our website. Let us know that you want to get in touch with Stuart, and we'll put you in touch with Stuart. Make sure that you get your thumbprint report done. Tell us about the thumbprint, Adrian. What goes on? What will people get out of this thumbprint report?
Get a guideline, something to where they're going, where they're heading in life.
Exactly. You can't. Can you go anywhere without a plan, without knowing what your direction is?
Most people are lost before we see them anyway.
Exactly. Most people have no idea where they want to go. So this helps big time. One of us will come and see you, sit down with you, talk about your numbers, talk about your goals, talk about where you want to be, especially in retirement, especially when it comes to mortgages, how quickly you want to pay those down. We'll get some information from you and we'll put together this fantastic report that'll put all your numbers down in the one place.
From the experts.
From the experts, yes. From the professionals that are associated with us. Yeah. They'll do that for you and alongside us. And they'll give you options in terms of where you can go from here. Make sure you get in touch with Stuart. As I said, jump on the website. We'll put you in touch with Stuart. Don't procrastinate. That's one of the biggest sins you can ever make in the financial world is procrastinate. Jump on the go train. That's what you've got to do. Jump on the go train, get a seat there and go to where you want to get to. Thanks heaps, Stuart. Stick around after the break. We've got Steve Hudson, our finance guru, so don't go away. Come back to us straight after the break. Welcome back to the Mortgage Busters show. I'm Greg,
I'm Adrian.
and wasn't that a fantastic session we had with Stuart?
Yes.
He's really good. He's the
Lots of
man
info.
that you need to get on board if you want to tidy up your insurances or get a better deal on your insurances. And ditto for superannuation. We have with us the famous, the most guruistic champion in the finance world, and it is Stephen Hudson.
Okay, guys,
Anyway,
how are you?
man,
Yeah,
good to see
good,
you.
yeah, good program, Stuart. Again, followed up from last week, talking about retirement. Guys, got a bit of a disappointment to put forward.
Oh.
I got a letter from the government today. It was my birthday a couple of weeks ago, almost a month ago now, 10th the 10th. Viewers for next year, don't send presents, just cash.
Just cash.
Right?
Just cash,
Thank
yeah.
you.
And gold bullion.
Straight into the offset.
Yeah, straight into the offset. The
Gold
Minister
bullion.
for Health was offering me a seniors card, and I'm not even old enough for this yet. Believe me, I'm not, right? So their data is not right. But the reason why I mention this, we're talking about procrastination. My father-in-law got this letter probably, 15, 20 years ago. He's 75, still working. Entertainer. He was out at store on Monday night at the RSL, still working. And we were joking and we were having a laugh about this several years ago. So the point is that what I'm trying to say is that time goes quick and you don't have time to procrastinate in this life.
No.
Because it won't be too long before you're getting one of these letters offering you a seniors card. Disappointed, but...
Can I just
you
say
know.
that thing again about procrastination?
Yeah, you can.
The train called Someday I'm going to do this, someday I'm going to do that. The train called Someday leads to a town called
Nowhere.
Nowhere. Doesn't happen.
And you should be on the GO train too.
Wealthy Town. Where's the camera? Wealthy Town, over here. I want to live in Wealthy Town. Where do you want to live?
Yeah, Wealthy Town,
Where
next
do you
door to
wanna
you,
live?
Greg.
Yeah.
Wealthy Town.
yeah.
We're on the GO train. Meet us on the GO train.
Yeah, that's brilliant. So the thumbprint report, guys. First step is to get the thumbprint report.
That's like the
into your
ticket,
hands.
the ticket to
is
get onto the GO
it is,
train.
It is. It's the ticket to the train to Wealthy Town. So look, it's full of information and it's your information. It gives you the foundation to actually start planning your journey to Wealthy Town. And we're here to help you with that, and it's free. So make the phone call, go to the website, ensure that you get it booked in for this, and also the challenge of just ask.
Oh, yes.
We've had a bit of a response for
Just
that.
ask, of course.
Yeah. So that's been a real good week in that regard, except for the letter. Not happy.
Yeah,
Not happy.
no.
Anyway, today we'll have a whiteboard moment, and what we would like to discuss is the opportunity for people to actually pay off their house in 7 to 10 years. And it's quite a simple process. A lot of people use this to advertise, pay off your mortgage in 7 to 10 years, and they'll use a term. But this is the formula that they use, okay?
The whiteboard.
The whiteboard.
The whiteboard.
So coming back down to my drawings,
Hut.
a little hut.
Pizza Hut.
This is your PPR. What's PPR stand for?
Principal place of residence.
So this is your home.
Your home.
This is your home, and we'll call this as 220K.
220?
420, sorry. Now this doesn't really matter what mortgage you have on, but for the sake of a figure, it's 300K. Okay, this is your loan. And there is many ways that we can show you how to do some crunching on this, some chunking on the loan to pay this down in hand with this formula.
Which has been very, very popular, your whole chunking strategy.
It's a great focus for people. So what the formula is that you buy a property investment here, and we call this 420. Now, what did you say that properties double in how many times? Years?
Well, the real number is 7.2 years.
7.2, but usually
Melbourne?
usually in the financial industry we'll say 10.
10, because it's a nice round number too.
Well, conservative. Okay, so the theory is that this will stay. Your mortgage is going to stay at 300. This is going to be worth 840 in 10 years' time, and this will be worth 840 in 10 years' time. So along that journey, somewhere along the line, it's going to be worth $720. So you can actually pay off that mortgage in that wherever that timeline is, because houses just don't go in a straight line like this. There's a bit of a bump and a bit of a turn here and there, but somewhere it's going to be worth $720. There's going to be some selling costs if you want to do that particular way, but we can actually get you into this house, 100% mortgage, depending on the equity that you've got in this particular place, and it doesn't cost you 1 cent to get in there. We can also give you funding. That's called cross-collateralisation, and we can also do it another way where it stands alone. But the principle is here is using time on your investment to actually increase in value, then using that equity to actually pay off your own loan. And of course, there's some tax what's the word?
Implications.
That involved in this, but that's the picture. The videos you'll see online, that's what they're preaching, okay? That's how you pay off your own home in 6 to 10 years using an investment property, and you using inflation to actually
But
increase.
it's a great strategy because
it is.
you know,
Brilliant.
most people today are in trouble when it comes to retirement. So why not put a retirement nest egg, start putting it into place with an investment property,
Absolutely.
or, you know, and pay your mortgage off quick.
Now this is a magic number. Now in 10 years, we'll call this 840k, took 10 years. How many months in 10 years?
120.
120 months?
Doesn't sound like much.
Doesn't sound like
No,
much.
it's not.
Divide that into that, and that's $3,500 per month gross.
That it's growing in value.
Well, that's
Yeah,
that,
correct.
So,
Yeah,
so
yeah.
that's the increase. I mean, it is a brilliant way of actually making money,
It's in many cases it's more than what the occupant earns.
and that's not including inflation. So,
Correct.
plus the rent.
Correct.
Now, also we can show you through
Very
what
good
we
stuff.
call a property investment analysis report that we do for nothing. For the people that get the thumbprint report,
Mm-hmm.
we can do a mock one of these on the tax rates that people have. And we can actually see if it's going to cost them any money per month on a cash flow basis.
Yep.
So, you know, it's a good opportunity.
It's a fantastic opportunity. It really is. You know, I was working with a group of teenagers for the last 10 or so weeks, and I've been taking them through, you know, a bit of financial disciplineship or whatever the word is, and how to invest in terms of my experience in the share market and my experience in property. And they are so primed that when they go out, they know already that, you know, they want to put their money to use, to work, rather than just to not have a goal and a plan and just squander it however which way. I mean, we're not talking about suffering here. We're talking about having a great life, and living a great life, and enjoying life to the max,
When you
but
need
just making the right provisions that you need to make to protect you and your family today and into the future. Yeah.
So in review for, you know, from today's point of view, is that, you know, that one day that people are going to get that letter, they're going to
Yeah.
procrastinate.
Yeah.
They've got to get in on
Forget
that train.
procrastination.
They've got to go on that train, the GO train.
The GO train to Wealthy Town. Steve, we've got to stop there. Man, we're out of time.
Thanks again.
So go to our website, ladies and gentlemen, do yourself a favour, put your name down there, we'll be in touch, we'll get your thumbprint done, we'll get you on the right path, to pay your loan down quick and also get your retirement into order. Thanks for watching. On behalf of Steve, Adrian and myself, see you same time next week.